Hello, everyone, and thank you for joining today's webinar. And my name is Ruben, and this webinar is hosted by Nurture International with partnership with the University of Oxford and Carbon Pricing Leadership Initiative at the World Bank. Today, we are going to discuss the role of sustainable finance, and joining me is a wonderful panel of three. And on my panel, I have Bruce Stewart. Bruce is the head of debt capital markets origination at Nedbank. I'm also joined by Tanya Dos Santos, who is the head of group sustainability at Investec. And we have Avana Singh, who will be joining us later as the principal head of sustainable finance at Nedbank. To start off on the session, I'm gonna run you through a bit of housekeeping points just to help us with the session for the next 1.5 to 2 hours or so. So all audience members, you'll be listening in without video. And if you have any questions during the webinar, you can just use the Q&A button, which is on the left of your screen. And please, when you send in your question, please state your name, your organization, and the panelist to which the question is directed. We will collect all the questions that are relevant to the whole group, and at the end of the session, we will post them to all the speakers. If you experience any difficulties, please see the Zoom technical guide, or you can use the Q&A button to speak to us as well. Just to remind you that the webinar is being streamed on Facebook, LinkedIn, and YouTube, and participants can also watch the webinar live through these other channels. At the end of the webinar, you'll be routed to an evaluation form, and we are very keen to get your feedback, so please spare some time and do complete the survey form. Just to run you through the structure of the webinar, we are going to be having every of our panelists have around 20 minutes to share their presentation. And then we are gonna have a Q&A session at the very end. So before I welcome my first panelist, as I mentioned, my name is Ruben. I'm the Africa Regional Coordinator of UNEP Finance Initiative in Africa. And in our role, we help banks, insurance companies, and investors to orient their business models to ESG factors and how to tackle climate action as part of their business model and business operations. So to start us off, I'm going to give over the floor to Bruce to run us through the first presentation. And Bruce, welcome. As we have you on board, Bruce, just to mention one fact as we were preparing for this session. So UNCTAD estimates that the global funding needs for SDGs will be in the order of $5 to $7 trillion annually. And of this amount, around 2.5 trillion will be needed in developing countries. And as we all know, most of the countries in Africa are in the developing countries category. So Bruce, as you run us through the session, will be of interest for us to know, given your deep experience, 20 plus years in the debt capital market, you can help us understand what are the financing options that exist for SDG goals and what you see as the role of Nedbank and also like other banks within the market, both as borrowers and as lenders in the debt capital market to finance sustainable investment. So Bruce, over to you.
Thank you very much, Rubens, and thank you for the opportunity. And good morning to the listeners, viewers, wherever you might be. It might be afternoon as well. Before I get into the slides and the presentation, which is pretty brief, I'm just going to speak about a lot of it. Nedbank's embarked on a journey in the last while that's been nothing if, how can one say, challenging in introducing the role of sustainability and investing in sustainability. You might think with a corporate color as green, it's sort of subliminally involved in your mindset anyway, to say, well, let's think green, and you go to the green bank. But what have we actually done about it? And if we've taken this fairly seriously, and our journey started about 2 years ago. We're coming to the end, I won't say the end, but probably we've had 10 years of digital disruption, and we're looking to steer our business into the next business cycle. So the opportunity to invest in sustainability and all things related becomes a business imperative for us as a bank, not only as a financial institution in terms of us being able to reorient capital flows and guide our clients, but also because we're also a borrower in the debt capital markets. And how do we effectively utilize those opportunities? And we'll unpack that a little bit further later on. I think banks face increasing pressure from wholesale debt funders, equity investors, and policymakers to allocate capital to sectors where it's needed the most. And those banks which do not pivot to a low carbon footprint or a sustainable model are said to be the ultimate or relative losers of capital and liquidity. So this becomes a business imperative down the line. If you're able to pivot your business as a bank, and I'm talking about embracing sustainable finance as such, to capture an outsized share of the revenue that's anticipated to emanate from the sustainable finance market. It also brings another lens with which you can manage your reputational and financial risks. And without those lenses, you run potentially a greater risk in terms of clashing with your investors, both debt and equity. I think the sustainability-focused banks will also benefit from growing investor and policymaker focus on the role that banks are playing. Basically, banks essentially, in our role, we would see it as proactively supporting the transition, increasing the relevance and purpose of our existence, and enabling Nedbank to capitalize on future bank flows, future capital flows. So we know, for example, that a growing number of savers and investors will be looking to choose products with sustainability credentials in the future. And we've seen this pattern increasing, and it's a growing trend. You mentioned almost 3 trillion, 2.5 trillion, an emerging market requirement. So absolutely, a growing number of savers and investors will be looking to choose products with sustainability credentials, thereby driving capital towards those companies that are already leading that change. So positioning for the trend and being able to create the relevant services as a financial services provider and providing the appropriate products from the sell side would therefore have a positive impact on our liquidity and funding as a bank. So just further substantiating why one would want to invest in the concept of sustainability. I mean, no one's going to question the focus or that motivation. It's also useful, I think, just to understand sustainability, when we look at it, encompasses the environment, social governance. So our journey primarily started with green, and we'll take you through some of the green specifics later on in the discussion, particularly my colleague Arvana Singh, when we talk about the renewable energy green bonds being our stepping off, our starting point on our journey. But for us, it was vitally important that Nedbank positions itself on this wave of sustainability, with a particular focus being a bank of unlocking commercial opportunities through, as I said, reorientating and focusing on innovative financial sustainable solutions. One of Nedbank's core philosophies is to use our financial expertise to do good. And this is one way which we can enable that, we can effect that. The challenge for us, I think, when we looked at sustainable finance was, how do you create a tangible link between theory and practice? A tangible link to demonstrate the core tenets of our philosophy. And really the only way to do that is to actually put a couple of transactions in place. And I mean, we had to create our journeys. And I speak from our experience, and I'm the head of a sort of a product area, debt capital markets, which was fortunate enough to be able to find itself in a position where we could deliver a tangible product to Nedbank, and in that process create significant awareness both within the organization and externally, that strengthens our relationships with clients, that creates an awareness internally as to how significant this is, because this is all about momentum. And going forward, we'd like to think that momentum is critical to ensure the acceptance of change. This is all new and different. Well, it was. Things changed so quickly that it was new and unknown 5 years ago. But I mean, as I said to you earlier, this is going to become business as usual, and our focus on sustainable finance will become business as usual. But to get there, you've got to convince a lot of people that are caught in the humdrum of a very routine environment, routine life, to say, listen, guys, that's not good enough. We've got to change it. And to some extent, I think COVID-19 has given the world a significant wake-up call in that regard. So, it's been an interesting journey that we've undertaken to get to the point where we are today. Maybe I would just go through onto the first slide that I have, and it talks to a point of growth in the sustainable finance market. I mean, we know it's significant. And there I mentioned the issuance of impact-based instruments is growing across the globe, both in the bond market, and so my experience is in the debt capital market space, but also in the loan market space. And you can see from the two charts that we have there, the relative growth in green, social, and sustainability bonds in US dollars. But what's also which didn't take off as quickly, maybe because it wasn't such a public market, was the loan market. Having said that, I think probably 80% of the capital flows in Africa are denominated in loans as opposed to bonds. So it's equally imperative that the loan market embraces the green bond principles, the social bond principles, as evidenced by, for example, the International Capital Markets Association, and all under that umbrella of sustainable finance. Now, I mean, you could look at the growth, it's exponential, and I would anticipate that growth would continue in the vein that it has. So, as I said, I think it's important for everyone to understand that when we talk about impact-based instruments, we are focused on use of proceeds as opposed to outcomes-based specifically. So use of proceeds, particularly relevant in the debt capital market space. And use of proceeds contributed towards making a positive impact on the environment. Social bonds and use of proceeds deployed towards activities that provide the socio-economic benefit. Important to make a distinction from an African point of view that, if we want to look after the climate and the environment, we are going to have to manage what is ostensibly an equally, if not more relevant imperative in the African context, and that is the social impact space. Because if you're not getting education and health and water and the basic sanitation that you require, looking after the environment assumes a secondary level of importance. So I would certainly put that up as a flag to say, listen, we are certainly mindful from a Nedbank perspective of how we deploy capital, how we reorientate capital, to ensure that we don't just focus on, for example, on green, which is a subset of the broader sustainable finance market, because that's so interlinked with what is imperative in our emerging market environment. Okay, just moving on to the next slide. Just wanted to talk briefly through some of the advantages and considerations for borrowers. And I know that when I look at it from my perspective, I'm head of an advisory team that develops green product or sustainable finance product for our clients. So we would advise them on how best to come to market with a social impact bond or a green renewable energy bond. That's on the one aspect. One of my bigger clients, as one can imagine, is Nedbank itself. And so we look at the considerations and advantages for a borrower, and this would be from how does Nedbank benefit from tapping into this world of sustainable finance. So maybe just to go through some of the circles on my slide, it's certainly a public tool to demonstrate moral leadership on sustainable change. First and foremost, it's about getting the mindset right. It's about getting the philosophy and the ethos that's deeply embedded in Nedbank's culture to ensure that the organization as a whole is aligned with what you're thinking. Now, sustainability is one of our core, I think we've got 3 strategic themes in Nedbank, and sustainability is one of them. Innovation happens to be another, and disruption a third. And I mean, ever since our group managing executive identified 9 of the 17 sustainable development goals, and each one of them took accountability for the implementation of those goals. For example, Mike Davis would look after energy, which is SDG number 7. And so he would be a sponsor and I can't say a strong motivator for that throughout the organization, which then it really helps to have a concerted effort, not only from the bottom up, but from the top down, that you have this mandate to focus on how critical and create an awareness on sustainability. And that moral leadership, it talks to some of the points that you made up in your intro, in terms of the conference objectives. How do we get leadership to set the example? And certainly that is something that, we have an influence on corporate citizenship, and we'd like to use that influence positively and constructively. Whether you are reorientating capital or you're putting out policies on high carbon emission lending, for example, on coal policy or oil or gas, that all plays into it. And you would have seen more recently, I think, Standard Bank's been picking up a bit of flack just from investors as a consequence of that. So it's very, very important that we are mindful of our level of public interaction and what we do, and that we lead by example. Certainly another advantage of the sustainable finance world, we know that investor mandates, as you mentioned earlier, $2.5 trillion getting focus in terms of investment, and that's the demand. But I mean, if I look at just from a bank point of view or financial institution point of view, opening up additional pools of liquidity and capital for any borrower is ideal. Not only because you might get greater participation in whatever you're issuing, which could lead to spread compression and a more cost-effective source of funding, but it also reduces your funding risk. And it's good to have both domestic and international investors participating. We had that, and I think Ravana can talk a bit about it later in terms of our renewable energy bond. We had institutional investors phoning us from London, and I granted it was a rand-denominated bond, but funding from London to say, listen, can we participate, or could you do this in dollars, please? And given that it was our first renewable energy bond, and we raised 1.6 billion, I think, rand in the first initial issuance, we were very pleased to have that kind of response, because it was being taken note of globally, bearing in mind that when you reduce carbon emissions from Eskom, you're pretty much getting maximum bang for your buck in terms of reducing carbon emission. So it's a well sought after replacement mechanism if you can finance a wind farm or a solar farm. In addition, I mean, a commitment to ESG can result in the bonds being included in indices, and I spoke earlier a bit about the ability to create an alternative yield curve through spread tension. I mean, right now in South Africa, I don't think we're in the same space as the European markets, where there is a distinct difference in pricing for sustainable finance, depending on how it's being constructed and the assets underneath it and so on and so forth. In South Africa, there's still very much a focus on the commerciality. So we can achieve both here. We can achieve a commercial return, and we can achieve a real positive impact if we take, for example, a commitment to a renewable energy green bond. And I did mention that there is the potential to price marginally tighter in secondary markets. And I think that will develop over time. Right now, though, one's got to play it a bit cautiously if you think that you're going to come to market in an emerging market and benefit substantially from price reduction because it's green or it's sustainable. These things, as I mentioned, lots of considerations one's got to take into account. And not least of all, as a borrower, you've got to understand, what are you going to be using this funding for? What sort of assets will you be deploying it to? And then you have to go through that whole verification and certification process the second opinion providers and the like, to ensure that the integrity of the capital that you're raising and is accurately referenced to the assets and the deployment of that capital. I mean, internally, we spent a lot of time understanding and defining the processes and the taxonomies. Creating an ability to map expenditures and verify spend is crucial to maintaining the integrity of these instruments. You know, the reporting and measuring is another whole workload that goes behind this. So from a debt capital markets point of view and a borrower, Nedbank would say, we can issue a green bond, we can issue a sustainable bond or social impact bond. But bear in mind that raising capital, you've still got to have the taxonomy internally that manages the appropriate allocation of that funding to specific projects. And that disbursement of funding is critical to manage. But in addition to that, it's also about understanding how do you measure the impact of those particular assets that you funded and then report back. So it's like almost like a three-legged process. You raise the capital, you ensure that the disbursement follows the processes and taxonomies that have been agreed internally, and then you need to report back and monitor. And essentially, I mean, when we issue a Nedbank Renewable Energy Green Bond, for example, there's no enhancement to credit risk per se on that instrument, even though there's a positive impact it's based on a positive impact. But what you do find is that additional institutional investors might participate because it's infrastructure related. And what we did see price tension improve, and our pricing was slightly below where Nedbank senior debt might have been. So that was all good. But it's also useful to understand, and I think there's a lot of empirical evidence out there to suggest that if you have a sustainable finance lens on your business, it's just another mechanism, another insight, another view that investors, whether they're debt investors or equity investors, have of your business. And as I mentioned, there's empirical evidence to suggest that the risk-return profile, even if the returns are the same for sustainable finance initiatives and non-sustainable finance initiatives, I would suggest to you that there's a more transparent view of risk, and so the risk-return profile would be beneficial in a sustainable finance instrument methodology. So just to round off, I've got 20 minutes max to carry on. How am I doing for time, Rubens? Okay.
You've got 3 minutes.
Okay, it's all good. You know, I just wanted to talk about Nedbank's contribution to the green bond development, and obviously we have a very strong renewable energy team, and that renewable energy procurement program that South Africa runs is probably one of the best renewable energy programs, as evidenced by its effectiveness, I think, globally. And we were significant participants in that, and that led us 2 years ago in 2018 to say, listen, we need to do our bit to align ourselves with the world of sustainable finance and to create a tangible link between the theory and the practice. And so we saw an opportunity to create what we call a renewable energy green bond and raise capital for the specific deployment to certain assets, and Arvana will talk about that in a moment. But this was a really interesting journey, and the ability to package an impact-based investment with metrics such as CO2 at the time and even now was really significant for us, because it contributes to our sustainable ratings and our ability to, as I say, one of the biggest challenges, our ability to communicate to all internally and externally. So we did a lot of education leading up to this, not only internally with our management and leadership and staff, but also with clients and with investors, going on roadshows, explaining to them what the Sustainable Development Goals were, what the Paris Accord was saying, what about climate change, what are we planning to do about it, how damaging CO2 emissions are. So there's been this whole build-up in terms of sharing and knowledge sharing over the period, and I'm proud of the fact that we can sit back and say, you know what, we've got the guys on board, we've got some momentum, and the renewable energy instruments were a great example of meeting the dual needs of return and impact for us. The underlying projects being renewable energy in nature also allowed, credible and positive environmental impact. And we test this against best practice taxonomies. Climate Bonds Initiative certainly involved, and as were the Carbon Trust. In fact, there's a quote here that I have from Climate Bonds Initiative to close off that pretty much says, with the certified green bond, Nedbank are taking a leadership role on green finance in South Africa, building climate-based and sustainable investment markets to help others achieve their NDC targets. Requires financial institutions, banks, insurers, and pension funds, all the way up, to step up to the game, to step up to the plate. And Nedbank have done that, and that's from the CBI themselves, the CEO, saying, well done. So that was just a small step in the right direction, and I get a sense that the tsunami is still coming at us, and we cannot relax.
Thank you, Bruce, for sharing with us. I can see we are having quite an engaged audience with questions coming in. As I invite Tanya to move on, I want to read a question from Gathia Mahed from Nelson Mandela University, which I think Tanya is going to be able to address at least the first portion of the question. And Gathia asks, what defines sustainability and what other instruments are plausible for investment vehicles? Tanya will be speaking on the investment landscape, and much more how can businesses and financial institutions integrate climate action within their core business. And tying to this is a point that I noted where you said, Bruce, that there are three things. Companies need to be able to have taxonomy, or we can also call them guidelines, to say what's sustainable and what's green and what is not. Then there's also the second thing of you need to do your impact assessment or impact measurement, and the last bit, which is the reporting and disclosure. So I'm going to invite Tanya to take us through what climate action means for investments and businesses. And just to reintroduce, Tanya is the Global Head of Sustainability at Investec. Welcome, Tanya.
Thank you, Ruben. Thank you, Bruce. I think we actually dovetail quite well. While your bank has a lot of green, my bank is very black and white, but I have some green running through my veins. Just like Nedbank, Investec has also been on the sustainability journey for a very long time, in fact, since inception, except ours came more of a social base than a green base. And if I think back to the very first sustainability report that I wrote, which we actually called The Journey to Sustainability, recognizing that this was something we would be doing for the long term, we had, I think, less than half a page of what we could write about in terms of environment. And it was all internal stuff. It was operational. There was nothing in terms of products and services. So to reflect back 20 years, at a climate conference, and to see how much progress has actually been made in this space, for me personally, is very gratifying. I'm going to focus a little bit more on the Sustainable Development Goals, assuming that our audience have some level of understanding. The Sustainable Development Goals were brought into place in 2015, and our current CEO, Fani Titi, has actually been invited as one of 30 CEOs from around the world to join the United Nations Secretary General in what they call the Global Investors for Sustainable Development. And really their intention is to do exactly what Bruce was talking about, where you are channeling funds and capital to the areas of greatest need. And for me personally, environment and environmental factors underlie all areas of all 17 goals. So from eliminating hunger to reducing inequality and to building, sustainable cities, everything has a green element and has an environmental element. In fact, for me, they say you can't separate out the goals. For me, you definitely can. If we don't have SDG 6, which is water, and we don't have SDG 7, which is renewable and clean energy, we can't do any of the rest. So for me, start with those two, and you will see how quickly you can actually accelerate the rest. So just talking a little bit more about climate finance, I saw one of the questions was asking, where does the finance come from? And historically, the public sector was a greater finance in this area, but you're seeing more and more that the private sector are starting to play an important role. I read something the other day that the climate gap in terms of finance is estimated to be about $60 trillion out to 2050. So I think you were talking 2.5 trillion just in terms of the SDGs gap. But in terms of climate finance and what we need in order to get to where we need to be in 2050, it's a $60 trillion gap. And that's really going to rely on both the public and the private sector coming together and coming up with these products and services that Bruce is talking about, these innovative bonds and financial instruments that will make all the difference. You will have seen recently that banks have been under a lot of pressure. Bruce mentioned, the headlines around Standard Bank, but these few headlines are actually just in terms of the last week, maybe 2 weeks. And literally, I could have tracked this over the last 2 years. Every week, there has been headlines around banks doing things and financing things that, are frowned upon. And at the same time, you've got this graph on the right, which is, I don't know how small it is on your screen, but all you really need to see is towards the end on the right of the graph, is how much the financing of clean energy has come off in the last few years. So about 130 banks have signed up and committed to climate action, and yet we're seeing the financing of clean energy coming off over the last few years. And that's definitely not going to help us get where we need to be. And a large part of that and problem is that banks continue to fund fossil fuels. And actually, since the Paris Agreement in 2015, you're seeing the steady increase of the top 35 global banks who are still providing some 2.7 trillion in lending and underwriting to the fossil fuel industry. I'm not pointing fingers here. This is complex. It's a complex issue that needs to be unraveled and understood. But this is certainly making the financing of sustainability and of climate finance that much more difficult. Another interesting element that's come through recently is greening the boardroom. So while we're seeing a lot of financing of renewable energy transactions, we're also seeing that hasn't quite reached the boardroom. So the diagram on the right, I know it's probably not very legible, but all you really need to know, and we can send the presentation, and please go and have a look. This is research that Bloomberg's did. They show the top 20 leading US and European banks in the middle of the circle, and then it shows all the connections that their directors have to the biggest emitters, biggest corporate emitters. And as Bruce mentioned, Standard Bank has been under the gun this week around, I think it was 7 of their directors having ties to emitters. We need to be re-looking at what do our boardrooms look like. And then another element is around, it's not just banks that have a role to play, it's also the prudential and the regulatory environment that we need to consider. So this is a very, very recent report. It only came out yesterday. It's done by Finance Watch, which is a European NGO. And they say that prudential regulation needs to play a much greater role in ensuring climate-related financial stability. They say, actually, do less risk modeling, and we need to have more decisive action. And some of the proposals they're making, which would really make our risk modelers' eyes turn, firstly is for existing fossil fuels, to apply a risk weighting of 150%. And then for new fossil fuels, to apply a risk weighting of 1,250%. So these are the recommendations being put forward, and it could dramatically impact how we actually start viewing the risk of climate-related assets. So when I think of what banks can do, And I purposefully crossed that out because it's a must. It's no longer a nice to have. These are the things we have to be doing. A lot of banks are doing a lot. Some banks are doing very little, and then some are doing in between. For us, a climate strategy needs to incorporate all elements. You need to be doing all of these things. So firstly, it's that explicit acknowledgement of the role that banks and financial institutions have to play in financing fossil fuels, but also promoting and advocating for sustainable finance. And the second is, it's one thing to acknowledge it. And believe me, a year ago, I was still hearing executives in boardrooms denying that there was actually climate change issues and this was a fad and a phase and it would pass. Well, I think finally we have reached a point, especially with Davos, where people are no longer denying it. It's now accepted. But just acknowledging is not enough. You now need to put together a more comprehensive long-term climate strategy. When Bruce talks about how each of their executives have taken responsibility for an SDG goal, that is setting a long-term strategy. That is not Am I back?
Yes,
sorry,
you are.
Yeah, sorry. The joys of living in Africa. You see, we don't have great Wi-Fi. So I think are you still there? Can you hear me?
Yep.
Yeah.
Okay. The fourth element, which is something that Bruce also alluded to, is this element of engaging with all stakeholders. So it's no longer good enough to just go off and decide what you think is good and what strategy to apply. You actually need to get the views and opinions of the shareholder activists, of your shareholders, and of minority parties. And what they tell you will actually inform that strategy and the decisions that you make. Another element is to share best practice. We have a number of really incredible industry bodies, Bankers Association, to name one in South Africa. We're also working with PCAF, where banks are coming together and sharing their knowledge, sharing their understanding of this space, and then testing and aligning solutions, because it'll be very hard for the investors and asset managers to invest and compare across banking if we're all using different models. And then lastly, as Bruce mentioned, that transparency and accounting role are critical. We need to be reporting, and it's reporting both the positive and the negative, not just all the good stuff. So my last two slides are quite busy. I'm not going to go into all the detail, but it's really in terms of Investec's climate change framework. Our main strategy and our main aim is to transition to a low carbon economy. Our overarching strategy recognizes that we see climate change as both a risk and an opportunity. We support the climate agreement. Firstly, you've got to live it in your own home. So we have committed to ongoing carbon neutrality. And then a big part is around these products, services, and businesses that will actually help accelerate that transition. We are with our clients for the long run. So we're not turning around and saying, we won't deal with you because you're in a bad industry. We want to work with you. How can we help you to move and shift your business model if need be over a period of time? As mentioned, engaging with stakeholders and participating in industry bodies. Then governance is quite a key aspect, ensuring that you have the board on board, to have the board support. Fani Titi is actually our executive responsible for climate issues. We also have a social and ethics committee and a senior leadership forum that runs our full ESG specific matters, and a number of publicly available policies. So this has been an interesting one. it's one thing to have a number of policies, internal policies, sitting on your network and that you share occasionally. But actually, if you don't share it with the world, if you don't share it with your investors and your stakeholders, it's almost like you don't have a policy. So we had a coal policy for a few years.
Tanya?
Yes.
It seems the audience can longer see your PowerPoint. Could you mind resharing your screen?
Sure. Don't know why. Let's just see. Does that work?
Yeah, we can see them now.
Yep. Okay. Ruben, I'm sure we can distribute these slides afterwards as well to help.
Fantastic.
So I was talking, coal policy in South Africa in particular have been a hot topic. We decided to actually do a comprehensive fossil fuel policy, not just focus on coal, but focus on the full spectrum of coal, oil and gas, and then across the stream, focusing on extraction, power generation, distribution, and infrastructure. And I think that openness and that transparency has been really welcomed by our stakeholders. From a management perspective, as I've explained, that screening element is important, but that's almost the tick the box stuff that we should already be doing. The exciting space is the stuff in the middle, and that's the stuff that Bruce has been talking about. What are we actually doing to help focus and shift away from screening to actually accelerating sustainable finance? For us, we don't have SDG 15 and 16 as a priority SDG. We channel it all through SDGs 6, 7, 9, and 11. And the ultimate impact will be on climate change. And then lastly, as I mentioned, measurement is critical. We will be reporting in terms of the TCFDs. We'll put our first report out this year at the end of June. And most importantly is ensuring that you have related targets in your executive remuneration. And I think that's, we did a lot of research to see what other companies have done. There are very few companies that have done anything in that space. And then I think just in conclusion, for me, Antonio Guterres is such a role model. He talks about in planning for the coronavirus pandemic recovery, there is a profound opportunity to steer the world on a path that tackles climate change, protects the environment, reverses biodiversity loss, and ensures the long-term health and security of humankind. These things are all interlinked. We can't only focus on one. But one thing is for sure, we do need to build back better and build back greener. Thank you. Ruben, I think I made up some time for you.
Thank you very much, Tanya. There's some questions coming in, and just before I read two of them, I want to go back to something you mentioned and just reiterate. You mentioned 6 points. So one, businesses have to acknowledge, and I think a lot of acknowledgement is happening, and then they have to commit, demonstrate, then they have to engage, collaborate, and report. There are questions regarding committing, and someone is asking, what is Investec's policy on fossil fuels? And what does commitment look like for Investec for the fossil fuels industry?
Sure. So I don't know where the person who's asking the question is sitting in the world. But if you're sitting in South Africa, it's a very different picture to whether you're sitting in Europe or the US or Australia. So we have a global power and infrastructure business in all four of those geographies. And we had to take that into account when putting our fossil fuel policy together. So we actually engaged locally with Just Share, with a lot of stakeholders, but in particular with Just Share in the UK Share Action and Glass-Steagall in the US. They are the people who are really pushing for these policies. We specifically state that any investment in thermal coal will, in fact, any investment in any fossil fuel has to be escalated to a senior leadership forum for sign-off, any deal. In particular, if they are in certain areas, we would absolutely say no. In South Africa, in particular, we would consider a variety of socioeconomic factors like economic growth, poverty, unemployment, and then weigh up and decide after that whether we would or wouldn't. But our strategy is very much to shift away from fossil fuels towards renewables. We have a very low exposure to fossil fuels, and especially in terms of coal, we have a very low exposure. And our strategy is to focus on financing renewable and clean energy.
Good. I want to invite Bruce to answer the same question, which has been asked. What is Nedbank's climate policy? And in this regard, what does it mean for your policy on fossil fuels at Nedbank? Bruce?
Yeah, one's got to unmute these things, you know. So now I'm with you. I think very much along the same lines as Tanya said, and I think she encapsulated it relatively well. I think Nedbank is a South African bank. We have been heavily involved in the South African environment, yet we are extremely conscious of carbon emissions and fossil fuel policies. And I think I don't have the details of it specifically in front of me, but we certainly have released a coal policy more recently. We have made a number of submissions to our board that have been accepted in this regard. It's very much about how do we transition from financing, for example, coal. The coal is such an integral part of Eskom, and Eskom an integral part of energy in an energy-intensive South Africa. You can't just stop financing coal because the lights will go out and then the whole economy falls over. So it's about managing that transition, but I think we're doing that by example, in terms of leading by example, putting out our coal policy, and this is all public information. The guys can find that on the Nedbank website in terms of what our status is with respect to fossil fuel emissions, and in particular, specific policies relating to coal.
Good. Sounds good. Something that was mentioned, and just to pick it up, Tanya mentioned about, beyond banks doing this, there's the role of regulators. And I'm going to mention at the very end, we have a session tomorrow on, what's going to be the role of central banks and regulators in this. Two of the initiatives, at least, which I've seen that have gained so much traction within industry and which I work on a day-to-day at UNEP Finance Initiative. One is the TCFD, the Task Force on Climate-Related Financial Disclosures, which, for context, for those who may not know much about TCFD, this is a framework that helps businesses how you go about, making climate-related disclosures for your business. And they have a four-pronged approach, which is around, your strategy as a business, your governance, your data and targets that you end up coming with, and how you do your reporting for your business. And there's so many banks, leading banks, and mostly in Europe, and also quite a number of banks in Africa that have voluntarily signed up for TCFD. And we are seeing in some jurisdictions, South Africa being one of them, where regulators actually want to endorse TCFD, and ask the entire industry to actually become signatories of the TCFD framework. Something else we are seeing within the regulatory space, we have the Network for the Greening of Financial System, NGFS, which is the collaboration of central banks, leading central banks in the world, and just having a common voice on what greening of the financial system is going to look like. Because I think there's a general acknowledgement that if we are going to green our economies, we need to green the financial system, because the financial system plays a very big role in determining how resources are allocated within the economy. So Tanya, I do agree and reiterate what you said. There's a very key role for the regulators, both on the supervision side, but also on macroprudential guidelines on how we can end up incorporating sustainability as part of business, and especially within the finance industry. And something else, I know we are not going to cover this in this session, but also remember the finance system is way beyond banking. There are other sectors like insurance, and insurance is going to play a very big role in helping businesses to grow resilience. Because with the ecosystem at risk, with biodiversity loss that is happening because of greenhouse gas emissions, and climate change, then the insurance sector becomes very meaningful to help businesses build the much needed resilience and how to absorb climate related shocks. So yes, there's a point of industry, what players need to do, but also there's a point of, where regulators can help to shape the agenda. So I'm happy to bring on board our third panelist, Avana, to share with us. And Avana is gonna, take up from the presentation that Bruce had. Just to mention again, Avana is the Principal of Sustainable Finance at Nedbank. And welcome, Avana.
Hi, Ruben. Thank you. I'm on board.
Yes.
Okay, great. Shall we kick off, or would you like to open the session?
Definitely. Let's kick off. And as Bruce puts up the slides, I just want to bring to the attention of the audience, and I know Bruce earlier mentioned, so Nedbank became the first bank to issue a renewable energy bond in South Africa. And Avana, just a lead question to you as you kick off. What do you see as the role of the private sector and, particularly banks in financing sustainability and, playing a big role in the SDGs? And what can you make of the acceleration that we are seeing in the ESG consideration? So as you take us through the presentation, you can help the audience to understand that.
Sure. Thank you, Ruben. To answer your first question, there's certainly a significant role for banks and the private sector to play in financing sustainable development, especially in developing economies where the private sector really have the opportunity to become a part of the solution and in turn set the scene for their businesses to be able to thrive in the future. Effectively, the banks specifically touch virtually every sector of the economy, be it retail, individual customers, small and medium enterprises through the business banking franchise, corporate South Africa, as well as public sector in their financing levers. So really by touching virtually every sector of the economy, banks have the ability to meaningfully influence and foster change. And I think that's an ability that we sometimes forget that we have as we push or allocate capital towards sectors of the economy. So effectively, in our lending decisions and in the way we decide to effectively lend out to the economy, we've actually become investors in the real economy. So the role of a bank is to invest in the economy in various sectors and ensure that we are using the capital in a way that is beneficial to the economy. So whilst we've predominantly looked at traditionally risk and return metrics, I think more and more there's an increasing imperative for banks to bring in an impact dimension into that mix as we integrate ESG criteria. The other lever that banks have available to them is that, via our investment banks, we have the ability to create innovative products which would essentially aim to steer, or which can aim to steer and attract foreign direct investment, additional pools of liquidity, alternative pools of liquidity, as we see the impact investing and the ESG trend on the rise. And that's effectively what I'm going to zone in on into my presentation. Before I get there, the other option that banks have, or the other way that banks can contribute is via our risk mitigation strategies. So effectively, we have risk mitigation strategies that we can offer to our clients, be it in the form of reducing exposures to certain industries, or just to help the real economy manage its book, which I think really puts us at a critical role. So coming back to the renewable energy bonds, one of the driving factors for this, and Bruce would have covered a bit of this earlier, but really we wanted to step up to the plate as a private sector bank and be that instrument for change by providing an instrument for market development, and at the same time also raising awareness of the United Nations Sustainable Development Goals and how these can be related back to our funding and the tangibility thereof, and to effectively develop the market to spur new issuance. I really then like to take you through the journey that we've walked in this space. And Ruben, maybe I should pause there if there's any further questions, or can I delve straight into this?
I think you can go ahead.
Okay, great. So if we look at the journey that Nedbank has walked, particularly in the case of the renewable energy bonds, it started off with us needing to build a case for issuing a green bond, which would have required a little bit more time, a little bit more effort, a little bit more tweak and enhancements to systems and processes than would have taken us to have issued a normal vanilla bond. Now, as you may or may not know, Nedbank is a well-established issuer in the domestic RAN capital markets. We have a 75 billion RAN program, and we can easily access money if we needed to. And whilst ease of execution may have been a slight deterrent that we needed to basically cross, we needed to sell the vision as to why these investments were crucial for market development. And as we began to watch the space and unearth the space and really research it more and more and form networks and relationships, we quickly found that there is more value to a green bond rather than just labeling it green due to proceeds raised being deployed to a green project. There are other commercial benefits that we as an issuer could have taken advantage of. And that really has come in the form of this instrument being able to appeal not only to our traditional investor base, but in addition to that, pools of liquidity that have been looking for impact and return, which are increasingly popping up. And the objectives we then set for ourselves was, if through this green bond instrument we could attract at least a little bit of an additional pool of liquidity at a start, if we can price in line with where we would ordinarily price, and if at the same time we can actually provide an impact to our investors, we'd be meeting many objectives through the same instrument, and therefore, living true to our purpose of using our financial expertise to do good, and also demonstrating a shared value instrument where, we could do things better in a manner to actually channel impact and good and allow the economy to benefit from it. One of the key considerations when we were structuring this is we identified assets which were effectively new assets. So if you look at the assets we've identified on the slide, just to give you a brief description, we referenced a wind farm as well as 3 solar PV facilities. And effectively, we ensured that these facilities were new and were going to be constructed, once again in keeping with the theme of additionality and bringing on stream new projects. Particularly, these projects would then contribute to increasing the share of renewable energy in the global energy mix. And this aligns very well with SDG 7, affordable and clean energy under the United Nations Sustainable Development Goals, and particularly Target 7.2, which speaks to increasing the share of renewable energy in the global energy mix. At the same time, these projects were able to provide an estimation of the avoided CO2 emissions, as well as the renewable energy generated in terms of megawatt hours. And having the credible impact measure, which could be measured against a baseline, and with the baseline being the Eskom assessment in South Africa, which, as we know, we're quite a heavy carbon intensive country. By having this credible measure, we're able to appeal to at least 2 to 3 additional investors, and I would say 4 or 5 additional mandates sitting within traditional investor pools to be able to allow this instrument to fit into those mandates. One of the overarching principles of this whole instrument was effectively establishing an SDG issuance framework up front. Now, we could have gone down the route and established a green bonds framework in line with the green bonds principle, but we did want to make this framework a little bit wider at the outset to allow us to issue into various types of instruments. So whilst green is very dear to our heart, and it's certainly impactful in the context of South Africa, where we're moving the dial quite significantly on green renewable energy projects, we've also have the ability to issue into other developmental goals. This SDG framework was crafted in line with the Green Bond Principles as set by the International Capital Market Association. And one of the principles under this framework calls for a method of external review. Now, the method of external review is a recommended guideline by ICMA, and effectively it allows us to attach an independent view of certifying the instrument as credible under the Green Bond principles. And we found that this external review really adds impetus to the instrument, and it gives investors comfort. Now, there are 4 methods of external review that you can engage in, and the method that we chose as Nedbank was that of certification and verification. Given that we were embarking on a public auction and it was our first issuance, we wanted to make sure we used a stamp that would appeal to both domestic investors as well as global investors. We embarked on a non-deal roadshow, and we quickly found out that whilst mandates were not very prescriptive, the combination of how we structured all of these elements to result in an optimal outcome was going to be the key. So as I said, what are the projects that you are referencing? Can you compare those projects to a particular taxonomy or best market practice that would deem it green? Now, in the case of solar PV and wind, it's pretty. There's much less left to interpretation, and we then compared that against the solar and wind criteria set by the Climate Bond Initiative in terms of the taxonomies that they have on board, and these assets were then able to meet those criteria. We also employed the services of Carbon Trust as a verification agency, who effectively had a look at the systems and processes that Nedbank put in place in relation to the Green Bond. So we've had to put in place certain processes and systems to allow us to adequately evidence the use of proceeds as these were dispersed to our client projects, and to be able to tag them in relation to the green funding that we raise. So on the verification by Carbon Trust, the Climate Bonds Initiative had taken some comfort from that and therefore afforded us the stamp. Once we've had this external review, we then went and marketed this widely to our investor base. We've also spoken to a handful of international investors, and that really resulted in a successful outcome for Nedbank. For our first auction, we were 3.28 times oversubscribed, and as part of that, we were able to attract some foreign investment into the country, into these green bonds. I think it was very well received by the market. We received some positive commentary back from the likes of the Climate Bonds Initiative and certain the African Local Currency Bond Fund, and effectively, this is an institution that we partnered with, and it's basically an institution we'd like to work with going forward as well. Maybe to give you a bit more, if you move over to the next slide. Here we go. So really, maybe in summary, it is about getting the key building blocks in place, building a case for why one should engage in a green bond as opposed to a vanilla bond is the start. But the benefits will accrue to you as an issuer over time, provided that the other moving parts all come together at the same time. Establishing a framework in line with internationally accepted practice is key, and effectively the International Capital Market Association have been the steer in this regard, and it's a really good starting point to start the drafting of a framework, but it does need to be navigated, especially in the form of the external reviews, where there's various permutations and combinations that exist. There are various certification agencies that exist. There are various taxonomies, and having an arranger to bring that all together can be quite valuable. And then obviously on the back end, testing that with investors constantly. As I said, being able to credibly quantify and monitor the disbursements made from the use of proceeds, and to be able to measure the impact of this instrument are key to attracting those additional impact investments, as well as to ensure a credible and robust instrument with integrity. One of the issues that we were faced with on the roadshow was really around raising the awareness of the SDGs, as I alluded to earlier on. And I think, we've done that quite nicely with our first issuance, which then prompted us to actually issue a further green bond in October last year of another R1 billion. Once again, it was well received. I think after having embarked on that process for the first bond, it certainly became much easier the second time around. And effectively, we were then able to issue R1 billion once again, which is also well oversubscribed. What is key for us as Nedbank is, given the relationships we have formed in the space through our experience of these instruments, we are now able to take that. It's really important for us to be able to take that to the next level. And effectively, we are keeping a close eye on the impact investing base as that continues to grow and continues to rise. And at the same time, we are keeping very close to our issue objectives and to our client objectives to look at how best we can marry the two to enable a sustainable and thriving economy. And really, that is the journey we've walked, the outcomes that we've achieved. And we see this as the start of integrating environmental and social and governance objectives into our frontline and business areas.
Thank you very much, Avana, for your presentation. I just want to ask a follow-up. I'm looking through the questions, and I can see most questions are around three things. So some of our audience is interested in, getting a difference between, the different terms that we're using, green bonds and sustainability bonds and all that. I'm gonna come to that. I can also, there's an echo coming from my end. Maybe if we try go on mute, I can see if to fix it. Yep. So then the second question regards, the commitment by the different banks, and in this case, Nedbank and Investec, which I asked, and Bruce and Tanya explained, what's the policy around fossil fuels and what's the climate policy by Nedbank and Investec. Then Avana, a question to you. I have a student from the University of Oxford who is asking around, lending policies and innovative funding structures. I think the way we can put this question is, from the example you've given about, Nedbank, it's mostly from the borrower perspective, and the use of proceeds for the bond. If you think of the actual lending policies, what does that look like in terms of like green financing for the bank? And here it's in regard with the policies that guide your green lending, and how you actually end up identifying and funding innovative funding structures or innovative uses of loans from Nedbank. Avana, up to you. I guess you're on mute.
Sure. Thanks, Ruben, and thank you for the question. As you may have seen in the public domain, Nedbank, at its annual general meeting on the 22nd of May, did proactively put forward a resolution to its shareholders in terms of climate. particularly the resolution that was put forward and agreed with 100% consensus was for Nedbank to develop an energy policy by 2021, by the next AGM. And therefore, that is something that we are now going to be working on quite thoroughly within the bank to really pay forward a path in energy. And we've committed to providing that in 2021. So that's as far as the energy policy goes. In terms of the innovative product development, this is certainly something we are looking at within the corporate investment banking space as a start, and really looking to filter that through to other areas of the bank. We have been working quite closely with our group sustainability as well as our asset teams on the ground. And it would be good to mention that as Nedbank, our group Exco have adopted 9 of the Sustainable Development Goals, which we feel we can make a meaningful difference in through our lending activities. Now, those 9 Sustainable Development Goals have also been referenced in our Sustainable Development Goals issuance framework, so it gives you a sense of the focus that we've aligned for ourselves. We are now busy at the moment investigating potential transactions which would also be aligned with the theme of climate and sustainability, which I cannot comment on too much right now, but be rest assured that there is work in progress. I think very, very important to point out is that, you know, there's a number of moving parts that need to be considered, whether it comes to client requirements, whether it comes to investor requirements, whether it comes to requirements of the various exchanges that we have on board, whether the instrument is a loan, whether the instrument's a bond. So it's really around making sure that the deal stacks up first and foremost from a credit point of view, and then looking at how we can tweak those arrangements to ensure an innovative product which would meet many objectives.
Thank you very much for that, Avana. You've answered it quite well in terms of the policies and also giving examples, for specific sectors. And I just welcome the audience for the conference last week. We actually had 2 sessions which were very specific to the energy sector. So we had a session on the energy transition in Africa, and this is what this is gonna mean. And we also had a session on the future of oil and gas. And I welcome the audience at your own time. You can also have a look at the videos that will be posted, and just to get a sense of what this actually means for the energy sector. I want to ask a question which takes us more to the basics. There seems to be 4 terms we keep using, and I think it is of essence we clarify to the audience. There is green bonds, there is social bonds, sustainability bonds, and there's green loans. What's the difference? And I welcome any of you to answer that.
Sure, maybe if I go first and my fellow panelists, please join in. The concept of green is really around a positive impact to the environment, whether that may be through mitigation and adaptation efforts, or whether it's bringing on stream a technology that results in an avoided or reduced CO2 emissions into the environment. So that's really the concept of green. The concept of social speaks to social bond categories that have been identified, which would be more around access to essential services such as water and sanitation, access to healthcare, and really around uplifting vulnerable and disadvantaged groups and empowering them. And that's really the concept of social. So whilst you've got certain social bond categories and you've got certain green bond categories which speaks to the environment, you then have sustainability, which is effectively the intersection of green and social as defined by global international definitions. And effectively then, if you've got a project which has both green and social elements attached to it, that can be classified as sustainable. It's meeting those objectives. In terms of bonds versus loans, bonds, a very different instrument from a loan. Again, the emphasis on green is more towards use of proceeds rather than whether it's a bond or a loan. Bond and loan just differentiates between a bond is an instrument which you raise from the capital markets and effectively use institutional money, whereas a loan would be funding that's generally made of banks' balance sheets and has much more, would have a bit more requirements or covenants attached to it.
Great. Bruce and Tanya, do you want to add on that?
I think she covered it perfectly. Nothing to add. I mean, it is, like I said, they are subsets of sustainable finance. So, and I think as we progress, the definition and the granularity will become more evident. I mean, over time, I think the whole market is evolving. There's always talk of greenwashing and sustainability washing and what qualifies and what doesn't. But these are new concepts for 80-90% of the world. And so it's part of our responsibility to be thought leaders in that space and to advise and learn and grow as we move along.
Fantastic. That works. Tanya, do you have something to add?
No, other than to say the National Treasury paper in South Africa is available for public comment. And they refer to sustainable finance, but when you actually read through the paper, the majority of it is actually talking to green instruments. So there is a lot of confusion in this space. In terms of the Sustainable Development Goals, the United Nations are now actually coming up with a definition for exactly what would clarify and classify as an SDG Sustainable Development Finance. So it's very confusing, and I feel very sorry for people who are new to the space because there's a full spectrum of different definitions and range of different financial instruments. It's not easy.
Great. At this point, before I welcome the panelists to give us a parting shot on this as we wind up, I want to bring in a quote from one of my preferred champions on climate change in finance, and this is Mark Carney. We know that he's been a leading voice in terms of climate change in banking as the former governor of the Bank of England, and he ended up describing climate change as the tragedy of the horizon. And to quote him, he says, "Climate change is a tragedy of the horizon which imposes a cost on future generations that the current one has no direct incentive to fix." And he proceeds to say that, once climate change becomes a defining issue for financial stability, it may already be too late. And I think, what he essentially covers is that, there needs to be a sense of urgency in, tackling climate change within the financial space. And now I'm going to invite each of my panelists in the same order from Bruce to give us a parting shot in 2 or 3 minutes.
All right, thank you guys. I really appreciate the opportunity to share this with you. I mean, this has become such a big focus, I think, for everyone. And when we first started out, it was very much kind of like a side issue, but is so quickly becoming mainstream and a business imperative. It's like if you are if you're a financial institution like ourselves, like Investec, for example, you have to embrace this because it's like future-proofing your business. And it's about, bridging the gap to the world around you in terms of engaging with your clients, getting them on board, the regulators, and everyone who's involved from a participant point of view. So, yeah, sustainable finance, as I said, is the theme for post the digital disruption theme for the last 10 years. I think sustainable finance now assumes an ever increasing relevance, particularly as we start measuring the performance of various countries around the world in relation to climate change and climate mitigation and so on and so forth. But thank you for the opportunity. It's been great sharing.
It's been great to have you, Bruce. Thank you.
Ruben, if I can, just take the opportunity to answer some of the questions that were posed on the Q&A.
Definitely.
One goes to the Investec directors and in terms of their connections and ties to fossil fuels. So we haven't done an in-depth analysis. This is recent research that's come out. But as far as I know, particularly on the South African boards, our directors don't have direct ties. I certainly don't know their PA dealings, that would be private. But what I would caveat is it's not necessarily a bad thing for a director to have a tie. It's what do you do with that relationship, or what are you doing with that connection? So if a director has the right attitude and they working in terms of both of their board directorships to help the business shift and transition, I would see that as a positive. So as long as that director has a good understanding of what energy issues are and are helping you do the right things and encourage climate change transition, that's a good thing. So I wasn't saying that all, make sure no directors have any ties. The second question came around, someone was asking about, what's the difference between sustainability and sustainable finance? So for us, sustainable finance would be one part of overall sustainability. We don't have a separate team at Investec just focusing on sustainable finance. It would sit where it's relevant in the business. So for example, our private client business is piloting a solar platform for private clients where they can pay off a solar energy option through their mortgage. Our structured finance business, which is on the corporate side, launched the first environmental auto call earlier in the year. And then on our power and infrastructure side, they've created a clean energy fund, which is predominantly, it's black, 51% black owned, and it's predominantly focused on renewable and clean energy in sub-Saharan Africa. So the expertise lies within the business, and we as a sustainability team will work together to ensure that it's integrated across all areas.
Great. Before Vanna goes, I'm actually alerted that I may have missed some questions in the Q&A, and because we have time, I think it's of interest to be able to answer them. I think I'm going to read them out, and our panelists can decide, how they want to answer them. One is, when you talk about green funding, where is the funding coming from in terms of the composition? The investors, is it the state? Being local or national government, are they mostly, institutional investors or like, individual investors? So there's a question about the composition of, green funding and where the investment appetite is actually coming from. Then I see some questions which are South Africa specific. There's a question of, how do you capture your green bond, I guess this is Nedbank, in the national accounting for climate finance in South Africa. And then we have another questions that ask, Avana and Tanya, can you comment on the new sustainable finance policy by the South African Treasury? I think we can first answer those three.
Good. Maybe let me start off there, Rubens, just in respect of that question, where does the money come from? So ostensibly, this is about everyone participating. So governments, developmental financial institutions themselves, institutional investors. And when I talk about institutional investors, I talk about the range from pension funds, provident funds, life funds, asset managers, all who have a vested interest in fixed income as an asset class and have capital to deploy. So whether you're talking PIMCO or BlackRock, and I'm sure you've had those esteemed investment houses on your panels, everyone has a role to play. The challenge is to create a sense of blended finance that can enable this to flourish, that can crowd in the private sector where they want commercial returns, that can bring in concessionary funding from financial institutions like developmental agencies that have a mandate to support that. So the world of liquidity that's out there is significant, and it's looking to find a home across the world of sustainable finance, from green to social, as we've explained earlier on. So, and a lot of I think some of the panelists have referred to the bank's responsibilities and financial institutions' responsibilities, insurance companies as well, is to channel that capital between the private and public sector into the respective projects and assets that would then deliver the outcomes, whether it be renewable energy or education or whatever it might be. I hope that answers the question.
Sounds, I am satisfied with the answer. And if the person who asked, you have a follow-up, please put on the chat. I think we can proceed to answer about, accounting for the green bond in the climate finance within South Africa and the new sustainable finance policy by the South African Treasury.
Yeah, sure. So, at the moment we account as Nedbank, these bonds were issued last year in 2019, and it would form part of our general accounting policies. But it's certainly something we're open to investigate for future issuances. Moving on to the National Treasury policy, the sustainable finance policy. I've also had a look at that, as Tanya alluded to, and definitely a step in the right direction. I think it sets a good scene in terms of let's start thinking about sustainable finance. And I guess to Tanya's point, it was quite green focused, and maybe let's think about how we could potentially broaden that to various categories such as blue bonds and the ocean economy, etc., etc. So it's really it's definitely a step in the right direction, and great to see from National Treasury.
Fantastic. Moving on, Bruce, there is a question for you specifically. On the green bonds and the landscape within the debt capital markets. What do you see as the future and what's going to happen in Africa? Do you know any other countries that are up to issue green bonds anytime soon? And what do you see as the progress? And just for context, I know, for example, I come from Kenya, and we had Akon in Kenya issuing listing a green bond on the Nairobi Securities Exchange, which was the first bond. And I know this, there's seemingly appetite for this within the African market. So if you can just help us to see what the appetite and outlook is looking like across the continent.
So, thank you. I'm reading the question that says, Bruce, what African countries want to issue green bonds? I would imagine that any country that's wanting to raise capital would prefer to issue a green bond if they possibly can, for the reasons that we've discussed on the panel. I think you open up yourself to a wider, deeper audience of liquidity if you are green and can evidence green with some level of integrity. Now, I was in Kenya not that long ago, and Kenya is really fortunate in that their energy supply is zero. I think it's zero coal, and it's all renewable energy. So, hats off to someone like Kenya in that respect. But it's not only about energy; it's all about the environment. So, and a lot of African countries are big, borrowers in the Eurobond space, and there is significant support for green. So if you can take a green Eurobond to the European institutional investor universe, and it has the right credentials and is supported, then I think the opportunity is great. And certainly African countries should look more closely at aligning their capital raising initiatives in the debt capital markets, not only on the bond side, but also on the loan side, with green credentials or green bond principles attached to them. I mentioned earlier, I think around green bond principles and social bond principles, and certainly there's significant appetite out of global investment funds to support that. But also bear in mind that the fact that you make it green doesn't change the credit quality much. So once again, it's all come down to what is the credit quality of those African countries that are wanting to raise capital anyway. The fact that you can evidence green just gives you a better chance of getting getting it away to a broader audience and possibly more constructive pricing.
Thank you, Bruce. Ivana, do you have any parting shot for us?
Yes, sure. Thank you, Ruben. I think, the topic of sustainable finance is really something that should be looked at with a commercial lens. And when we speak about sustainable finance here, we're not speaking about CSI or philanthropy. We're actually speaking about using your main lever of your business and really your bread and butter, and where you can make the most influence, and effectively embedding the ethos of sustainability into that. I think maybe as the last point to make then is, in order to remain relevant to society and to remain relevant to our investors, to remain relevant to our policyholders, we do need to step up to the plate as private sector, and we need to continue this path of sustainable finance. As if we don't have this relevance and if we don't have this purpose in society, it can really be to the detrimental of the sustainability of our businesses as a whole. So I think, there's a broader philosophical imperative that needs to be embedded in the way that we do business. And with the reality and the vision in mind is that we would all continue to be able to thrive into the future. And with Ruben, I think that's my parting point, and thank you to the audience for listening as well.
Great. We're coming to the end of the session, and I want to thank everyone very much. We decided to keep the session to 1.5 hours instead of 2 hours, so we are basically at the hour. But I want to thank my panelists again. Thank you, Bruce, from Nedbank, for the insights you've been able to share with us, and all the considerations that banks need to put in practice, and how to think about green, including what advantages are there, and what the considerations mean like, and you gave us some 3 pointers on how to go about that. Tanya from Investec, thank you for explaining the climate action integration and what this means for business, and also going ahead to tell us examples from Investec and what this has meant about your sustainable policy, and also like your policy on funding fossil fuels in South Africa, and also helping us to understand, how the SDGs can, translate to financing and borrowing for banks. And thanks, Ivana, for explaining the case study on the Nedbank, green bond, being the first, green bond in the continent, and how you went about it, and what the challenges mean, and the solutions that you employed. And Bruce also piggybacked on that, and explaining what the landscape and the outlook is looking like across the continent. Very pleased for that. And of course, I cannot forget to thank the audience. Thank you for being very engaged, asking questions, very direct questions, and making this meaningful. And also to our organizers, for very much making this possible. Thanks to Nurture International for organizing this, to the University of Oxford. We are really grateful, and to the Carbon Pricing Leadership Initiative of the World Bank. Lastly, is to bring to your attention about tomorrow's session. We are going to have a session on the role of central banks and financial regulators in managing climate risk, and this will be at 4 p.m. South African time, and we urge you to please tune on. I can see we have some great audience on LinkedIn and Facebook and Twitter, and also on YouTube. Thank you so much for all of you who've been watching this. We truly much appreciate. And as a continent, as Africa, let's make this possible. Let's shape the ecosystem. Let's drive climate action, and let's change production and consumption patterns so that they are sustainable for ourselves and also for future generations. So on behalf of the organizers, I want to say thank you, and thank you for tuning in. Have a nice day.
Thank you.